This is where STR loophole is fundamentally different, right? We have three specialized partners working together for every client. One, our acquisition team finds and analyzes the properties. Two, our real estate CPA partners who focus exclusively on real estate taxation, structure the deal for maximum tax efficiency. And three, our cost segregation partners like Alex run the depreciation analysis before you close. All three are coordinating from day one. You're not managing three separate relationships hoping they align. We have already done that. So when we present you with a property, you're not just getting, here's a listing, you're getting the acquisition analysis, the exact cost segregation breakdown, the precise tax impact on your W-2 income, your true after-tax ROI before you sign anything. Let that sink in. The level of precision is why doctors and tech executives work with us. They are used to operating with data and certainty, and we give them that. What if I told you that before you even close up on a property, we can show you exactly how much you will save in taxes down to the dollar? Most people buy a short-term rental, then figure out the tax benefits. That's backwards. And it's costing high earners hundreds of thousands of dollars. Today, I'm sitting down with Alex Bagne, our cost segregation partner and one of the top cost segregation experts in the country. We are going to walk through a real pro forma for a property one of our clients recently purchased. You'll see the exact purchase price, the exact depreciation, and how it offsets your W-2 income or RSU proceeds before a single dollar changes hands. So Alex, what's the biggest mistake high earners make when it comes to depreciation?
Yeah, so the most common mistake is to fail to maximize depreciation by not using a cost segregation study. Many high earners simply take straight line depreciation, missing out on accelerated tax deductions that can dramatically reduce taxable income in the early years of ownership. So skipping a cost segregation study, and we'll go into that in a little more detail, it's akin to providing the federal government a long-term loan interest-free of your money. So that's certainly something that you wouldn't want to do.
Can you explain in simple terms what cost segregation actually is and why it matters so much for someone earning between 500K and 2 million per year?
Yeah, so cost segregation is an engineering-based analysis that breaks down a property into individual components, components that have more favorable tax attributes. So removable flooring like carpeting or vinyl ceramic tile, the appliances, the landscaping, all of those have much shorter depreciation periods, usually 5 to 15 years, as opposed to 27 and a half years or 39 years for real property. So a cost segregation study basically carves out components of a building that have more favorable tax attributes so you can accelerate the timing of your tax deduction. So high earning individuals, it front loads the tax deductions, which frees up cash flow. And when we're talking about short-term rentals, it can offset high W-2 income.
Understood. What makes cost segregation for short-term rentals different from traditional real estate?
Yeah, so short-term rentals can qualify as an active business. So it's akin to operating a hotel, allowing owners to use losses to offset W-2 income directly. Unlike traditional rentals, if you're talking about if you have an apartment building that you're renting out, or if you're renting out an office building, something like that, the income derived from that is usually passive income. But when you have a short-term rental, that's, as I said, akin to operating like a hotel where you're actively involved in it. And because of that, you can take those depreciation deductions generated from a cost segregation study and offset your other active income, which would include like your wage income.
Very good. So we're going to review an actually real life pro forma. Can you walk us through the pro forma? What's the property? What's the purchase price? And what did you find?
Yeah, so this was a property located in New Mexico, 4 bedroom, 3 bath. It's a 32,000 square foot home in a very nice neighborhood, beautiful property. The purchase price was $935,000, which would have a mortgage amount of 795,000 and a down payment of about $140,000. We have about $115,000 for renovation work and staging costs and so forth. Um, Income is about 154,000 per year. On the performance that you provided, what I like about it is you provided some comps down here too, that this isn't a unique strategy, that other people have been employing it and they've been generating revenue on it. And I think this is going to be slam dunk for the person who purchased it.
So, Alex, your team identified $230,777 in assets eligible for accelerated depreciation. Can you break that down? What specific components qualified?
Yeah, gladly. So the purchase price was $935,000, and we need to allocate a portion of that to the land, and then the rest would be for the improvements. For this particular property, we went on the property tax assessor's office, and we're able to get some information about the assessed values that would allow us to make that determination. So of the 935,000, we have 215,000 going to land, and the rest is going to improvements. So on a property like this, we're estimating that we could carve out 18% of it to personal property and land improvements. And those things are going to be eligible for 100% bonus depreciation, which is basically you can immediately deduct those costs. So the things that we're looking at would be like the carpeting, the appliances, the cabinetry. Um, this property had a nice patio, it had a driveway, it had superior landscaping to it, and factoring those things in, we could carve out about 18% of the purchase price, less land, to something that you could immediately write off. So we have almost $130,000 that would be eligible for bonus. And then we also had some renovation costs and some staging costs that we wanted to look at. And we were estimating about 75% of the renovation costs would be eligible for 100% bonus depreciation. And the staging costs, which are going to be like the furniture, the beds, the pots and pans, and all the necessary components to make this property into a short-term rental, those things are all going to be eligible for 100% bonus depreciation. So when you add that up, we're looking at about $231,000 of items that are immediately deductible to the taxpayer. And, here we've got approximately 40% tax rate. So if you multiply that $230,000 times the 40% tax rate, it's going to generate $92,000 of tax savings in the year of the project, the year that the property was acquired.
And our client is a physician couple earning about 1.6 million per year. Walk me through how this depreciation offsets their W-2 income. What does their tax savings look like in year one?
Yeah, so the nice thing about a short-term rental is if you have a certain level of participation in it and it's not a very high level, then you can use this number to offset your taxes. So, here we've got $231,000 of additional tax deductions. That's akin to making $231,000 less in income. And if you want to look at the tax benefits from that, it's going to reduce their tax bill by $92,000. And this is just the depreciation. On the flip side, if we look at the pro forma, this is going to be an income generating property for them that would provide years of positive cash flow for them. But we also have some very significant tax savings for them as well.
I know one concern high earners have is IRS audits. How defensible is this strategy? What documentation protects them?
So the strategy is highly defensible. The IRS actually has an audit techniques guide for cost segregation studies, which allows them to determine if the cost segregation study was done properly or not. So this thing isn't, it's not some sort of tax cheat or anything like that. The IRS is fully aware of it. This is something that they accept. And as long as you have a cost segregation study done by a qualified individual and they're providing the detailed engineering reports and so forth, it's going to be very defensible. On rare occasion, they do get looked at. I know our firm, we provide free audit support, being a CPA and an attorney. I'm also licensed to practice before the US Tax Court. I feel very confident that I can defend the studies that we have. So far, we've never had a client ever give back a dollar to the IRS on one of our studies. So it's important to make sure that you have a quality cost segregation study performed, preferably one that's performed by a certified cost segregation professional, and that they do provide audit support.
Here is what makes our process unique. We are showing this client these exact numbers before they close on a property. Why is that timing so critical?
Yeah, it's critical because it allows the buyer to understand their true after-tax cash flow and return on investment before committing. They can structure the deal to maximize bonus depreciation and ensure eligibility for the short-term rental loophole. We often recommend that our clients involve their CPA, they involve their tax preparer to make sure that the savings that we're estimating are actually going to be realized. But again, it's very helpful to have this information up front because we don't want to sell anything that's not going to provide true value to our clients. And having this information where they can sit down, look at it, they can discuss it with others is really helpful in that analysis.
I couldn't agree more. And this is where STR loophole is fundamentally different, right? We have three specialized partners working together for every client. One, our acquisition team finds and analyzes the properties. Two, our real estate CPA partners who focus exclusively on real estate taxation, structure the deal for maximum tax efficiency. And three, our cost segregation partners like Alex run the depreciation analysis before you close. All three are coordinating from day one. You're not managing three separate relationships hoping they align. We have already done that. So when we present you with a property, you're not just getting, here's a listing, you're getting the acquisition analysis, the exact cost segregation breakdown, the precise tax impact on your W-2 income, your true after-tax ROI before you sign anything. Let that sink in. The level of precision is why doctors and tech executives work with us. They are used to operating with data and certainty, and we give them that. Let me give a real example of why this matters. We had a physician client earning about $650,000 a year who was about to close on a property in Florida. He reached out to us right before closing on the property. It was a decent property, and rental comps did not look bad at all. Honestly, seemed like a slam dunk. Obviously, we ran the full cost segregation analysis right away. Turns out the property was newer construction with less separable components. The cost segregation study would have generated maybe 80K in accelerated depreciation. For his tax bracket and goals, that wasn't enough to justify the purchase price and cash outlay. We showed them the numbers, and our client actually decided to walk away. 2 weeks later, we found him a different property, slightly older, better component mix. Cost segregation study showed $240,000 in depreciable assets. Same purchase price, but triple the tax benefits. And he closed on that one. And last year, that decision saved him over 95K in taxes. The only reason that happened is because we had the cost segregation analysis done before he committed. Alex, with 100% bonus depreciation back for 2025, how does that change the game for someone buying a property this year as opposed to last year?
Yeah, so it has a massive impact where bonus depreciation was phasing out, and in 2024 it was 60%. For 2025 it was going to be 40%. 2026 it was going to go down to 20 and then phase out completely, where a cost segregation would still provide benefit, but not nearly as much as when you have 100% bonus, where you'd just be able to immediately deduct the personal property and the land improvements that were identified in the cost segregation study. So the goal of a cost segregation study has always been to accelerate the timing of tax deductions, and with bonus depreciation coming into full effect for 2025 and onward, it only makes a cost segregation study more valuable, where it provides greater acceleration.
What typically goes wrong with DIY or a generalist CPA? Why is expertise critical?
Yeah, so it's important to have someone who understands the property. A lot of these short-term rentals, if you look at them, they look like just normal homes. And quite often people, CPAs, would just depreciate them as a normal home, which would be over 27 and a half years, which that's not the right answer. What's nice about treating it as a short-term rental, even though the real property you would have to depreciate it over a longer period of time, the interior renovations, you would be able to treat that as qualified improvement property and take immediate deductions on them. Quite often we see people who are trying to do it themselves, or someone who's just untrained, they're not properly allocating land. They might be taking too much or too little as personal property or land improvements. They're not providing adequate support, such that if the IRS were to come back and start poking at the project, they don't have the support to uphold the results of the study, and the IRS could very easily just deny the study and treat everything as real property. So there are a lot of potential issues there. With a certified cost segregation professional, they're going to understand the issues. They're going to know how to properly do a report. Many of them can provide very good audit support on it. In the IRS, they also want to know who's doing the study. And if you have that CCSP designation, they know that the the cream of the crop in this industry has reviewed the study. So there are a lot of things that can get missed. Not having a qualified individual doing the study, it could be as small as not taking as many benefits as you want, all the way to potential interest and penalties assessed against you by the IRS.
Understood. Are there any red flags you look for in a property where you would say this isn't going to work well for cost segregation?
Yeah, so I know on this property that we did the study on, there were several that we were looking at, and one of them had a much higher land value than the other. And the land is non-depreciable, so you want to allocate as little as possible to land. And one property had a much better result than the other. So the taxpayer did go with the one that had the lower allocation to land. So again, having a very high land value could be detrimental. Properties that have very minimal personal property or improvements could be not the best candidates for this. I know the properties that Arda that you look for, that's typically not the case, especially since you're using them as short-term rentals and you're going to help furnish the properties with very good furniture and TVs and everything that it would take to make it a good short-term rental. So I don't think we really have to worry about that. But, if someone was looking to buy, for example, a warehouse where it only has minimal land improvements and on the inside it's just a metal shell, a cost segregation wouldn't be very good. And then another thing is someone having a short holding period. So if you're buying this property and you're looking to get some immediate tax benefits, and then you're planning to sell that property within 2 years, 3 years, or something like that, I wouldn't recommend doing a cost segregation study because when you do a study, you're typically accelerating deductions that would be spread out over a lengthy 39-year period into 1 year. And if you're selling the property, you only get 3 years of depreciation that is accelerated into 1 year, and you have to worry about depreciation recapture and some other issues like that. So if you've got a short hold period on the property, I wouldn't recommend doing a cost segregation study unless there's something else going on.
Or someone watching this who is skeptical or thinks it sounds too good to be true, what would you say to them?
Yeah, so it's not too good to be true. We are very much following the IRS rules for, short-term rental properties, and cost segregation studies are well-established IRS sanctioned strategies. So with proper documentation and participation, high earners can unlock significant tax savings and improve their cash flow.